And at this point, as of this latest halving, the annual supply inflation of Bitcoin dropped below 1%, which is approximately half that of gold. Gold generally historically grows at estimates of something like 1.5% to 2% per year in terms of supply.
Hello and welcome to our channel. Lyn Alden begins by discussing the fundamental rule set of Bitcoin, emphasizing its decentralized nature and the role of nodes in maintaining the network. Unlike traditional currencies controlled by central authorities, Bitcoin operates on a protocol where the supply of new Bitcoins is halved approximately every 4 years. This process, known as halving, ensures that Bitcoin's supply growth rate asymptotically approaches its maximum limit of 21 million coins. The most recent halving occurred in April, reducing the creation of new Bitcoins and dropping its annual supply inflation below 1%. Which is significantly lower than that of gold. Alden compares Bitcoin's supply dynamics to traditional assets and currencies. Gold, for instance, typically has a supply growth rate of 1.5 to 2% per year, while developed market currencies grow at 6 to 9% annually. Emerging market currencies can see double-digit growth rates, highlighting the inflationary pressures in these economies. In contrast, Bitcoin's slow supply growth makes it a unique and attractive asset for investors seeking to hedge against inflation. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Yeah, so basically the rule set of Bitcoin is distributed among the people that run nodes. It's open source software, and so it's built into the code since inception. So every approximately 4 years, the amount of new Bitcoin that's generated every 10 minutes gets cut in half. So it's not that mining just one day shuts off. It's that mining starts out at a certain pace, and over time it asymptotically approaches 21 million. So back in April, the amount of new Bitcoin created every 10 minutes got cut in half, and approximately 4 years from now it'll happen again. And at this point, as of this latest halving, the annual supply inflation of Bitcoin dropped below 1%. Which is approximately half that of gold. Gold generally historically grows at estimates of something like 1.5% to 2% per year in terms of supply. The typical developed market currency grows at 6 to 9% per year outside of extraordinary years. Emerging markets like developing countries, they typically grow at double-digit currency supply growth over the long term. And so among fairly liquid monies or money-like assets, Bitcoin is now a very slow-growing supply. That's how I view it. I think the total addressable market's still notably higher than it is now. I don't know what it's going to do over the next 3 months, but yeah, I'm bullish with, say, a 2-year view or a 5-year view or potentially a 10-year view. I went through a long phase where I was pretty skeptical on the asset. I was like, well, what if another currency is going to be better? Or what if the whole space gets so diluted? But once I saw the network effects really form, once I delved into the technology and why it's designed a certain way, ever since really early 2020, I've been pretty structurally bullish on it. And that really continues to be the case, over 4 years later. Bitcoin is the fully decentralized, fully scarce version of that. It's the one there's no central hub. The thing you have to deal with is that higher volatility and the uncertainty of what it would be worth in, say, any given 1 or 2 year period. Whereas stablecoins, the downside is that they are fully centralized. There's some entity that's holding the assets, and you have to trust them. You also have to trust their ability to operate in a regulatory environment. But the way I would phrase it is they kind of serve as offshore bank accounts for the working and middle class rather than just the wealthy. They kind of just compress the overhead of running one of those systems where if you're in Argentina, you might not trust your own government's ability to run the currency. You might not trust the banks because in the past, even if you store dollars in them, they can get confiscated away. But they say, well, for small amounts of working capital, I'll trust this offshore entity. Well, there's a lot of different pitfalls that people could run into. One of them is just not getting started. That's one of the biggest ones overall. Another one is overcomplicating it. Basically, people, they get frozen by decision paralysis. They don't know how to get started. They get overwhelmed with options. A lot of financial investing content historically has been kind of jargony. It's kind of as though it's like put out of reach of most people. And I think another big one is over concentration. A lot of times when people do get interested in investing, they tend to get drawn towards some of the more high volatility or things that don't really compound super well. It could be, for example, people get really into like mining stocks because they're very volatile, even though they don't have a really good track record, or they get really into a big theme or something, rather than fully understanding what they're investing in. And so there's multiple things that people run into. Digital assets, yeah, basically I've been a bull on Bitcoin as well as stablecoins is really the two categories that I've found to be high utility kind of signal to noise. I've been very critical on the rest of the crypto space. Basically, when we think of what money is largely a ledger. So when people were using gold as money, they were basically relying on nature to provide the ledger, and we would augment that ledger with coinage and abstraction. But basically, we're kind of updating this ledger by physical possession of gold, and nature's kind of setting the rules for how you can make more gold or how to move around or authenticate that gold. Modern money relies on central bank ledgers, so basically we trust the Fed to run a ledger, and then banks are kind of layer two on top of that kind of centralized ledger. So we have this kind of two-tier money system, really kind of three-tier when you incorporate fintechs and things like that. So we have this kind of two or three-tier centralized money system. And the challenge there, so, in the US, at least for the past half century, we've had it pretty good. Our currency loses value slowly, and we have plenty of investment vehicles to save into. Whereas, for example, when you look at a country like Egypt, they don't have the S&P 500. They don't have, their stock market's not a reliable investment, kind of a wealth building vehicle. They've got real estate, but real estate's, of course, illiquid. So there's all sorts of downsides with that. They can't obviously invest in their own currency in any meaningful amounts because you've got an average of double-digit inflation over a 50-year period. And so what things like Bitcoin and stablecoins do...
Alden contrasts the financial stability in developed markets like the US with the challenges faced by developing countries. In the US, the currency loses value slowly, and there are numerous reliable investment vehicles. In contrast, countries like Egypt have unreliable stock markets and high inflation rates, limiting investment options. For residents in such economies, Bitcoin and stablecoins offer a viable alternative to preserve wealth and facilitate transactions. She notes that while Bitcoin is often seen as an investment in developed countries, it serves as a lifeline in regions with unstable currencies and authoritarian regimes. For example, many African and Latin American countries suffer from persistent inflation and multiple currency crises, making Bitcoin a crucial tool for financial stability.
So one of the attributes of money, it's that which you hold, even if you don't intend to consume it yourself. That's kind of historically where money kind of came from. And so, for example, if we hold a gold coin, we're not necessarily intending to melt it down into jewelry or industrial use anytime soon, but we're kind of holding it knowing that it's a useful thing that other people use.
Store of value.
Store of value. And as an American, to your point, we generally don't find ourselves troubled for payments or even troubled for savings. We have no shortage of savings vehicles that are reliable. But if you kind of view it as something that could be useful for billions of people around the world, something like half the world lives under shades of authoritarianism, half the world lives under kind of persistent double-digit inflation and multiple, hyperinflations within our lifetime. Bitcoin is something that Americans often treat more as an investment, and it's one that happens to have outperformed the S&P 500, the NASDAQ, almost everything other than NVIDIA over, 3, 5, 10-year period. So for us in America and Europe, it's often seen as an investment, which I think makes sense. But in, say, Africa, where there's roughly 40 currencies, or Latin America, where there's roughly 30 currencies, and every one of those currency borders is a friction. Most of those currencies are undesirable to hold. It's something that's useful to them, and that therefore it is an investment for people that kind of understand that there is a use case, even if the use case doesn't apply to them. And like America, I do think that we are running this more structurally high inflation because of the things we talked about earlier in this discussion. But that doesn't mean they have to happen super quickly. It doesn't mean that things have to end. If you kind of do the rough math, I mean, Congressional Budget Office expects 20 trillion in net treasuries to be issued over the next 10 years. They also assume no recessions. So if there's recessions, that number is probably going to be higher. They generally undershoot the numbers. So let's say conservatively, 20 trillion in treasuries are going to be issued. If you look at how much, gold's going to be mined over the next 10 years, at current prices, it's somewhere in the ballpark of 2.5 trillion. And the amount of Bitcoin that's going to be created at current prices is something like 70 billion. Now, of course, gold and Bitcoin can change in price to accommodate more inflows if people want to put more money into them. But the point is basically, if you're just kind of saying, what do I want to own that's pretty scarce? Obviously, good equities are one of the options. Good real estate can be one of the options. Art is historically one of the options, especially for wealthy investors, but also Bitcoin is, because it's liquid, it's fungible, it's portable, and it's got a lower kind of new supply growth rate than a number of other kind of liquid investments. So I think from an American perspective, it's often viewed as an investment, whereas in other countries, it could be viewed as a lifeline. If we were to pivot toward austerity, there's a decent chance we would get kind of flattish asset prices. And then therefore, you could ironically continue to widen the deficit anyway. It's a very hard tailspin to get out of. You'd have to, I think, not just tweak your revenue and spending model, but you'd have to kind of overhaul some of the ways it works, which would make it even harder to do in a very polarized environment. Generally speaking, when countries get out of this, like we got to similar debt levels in the 40s, we had much better demographics back then. We had a much stronger manufacturing base. But basically, what countries do when they find themselves here is they generally run financial repression, which is that they hold rates below the inflation rate. It kind of slows down the interest expense of the public ledger, and therefore can kind of slow down the money supply growth. It makes your currency fairly undesirable to outside entities, which is not what we're doing right now. That's what Japan's doing. But I think that's kind of in the cards for the U.S., which is basically that we're going to have a period of time where interest rates are just not really keeping up with inflation. If you're holding currency or bonds, you get kind of gradually devalued.
Alden acknowledges that high inflation is a structural issue in the U.S., with significant implications for the future. The Congressional Budget Office projects $20 trillion in net treasury issuance over the next decade, not accounting for potential recessions. In contrast, the supply of gold and Bitcoin remains relatively fixed, making them attractive as scarce assets. Bitcoin's liquidity, fungibility, and low supply growth rate position it as a strong contender among liquid investments. Alden suggests that the U.S. might eventually resort to financial repression, where interest rates are kept below the inflation rate. This approach would help manage the public debt burden, but could lead to gradual currency devaluation. She draws parallels with Japan, which has adopted a similar strategy to cope with its economic challenges. Please like and subscribe my channel.